Fed's main tool for trying to either accelerate inflation and credit or decelerate inflation and credit is interest rates. Um, and so when they raise interest rates, they can generally slow down the rate of borrowing by making borrowing less attractive. And if they want to accelerate borrowing, they can lower interest rates and therefore try to provide a boost. The problem is the federal government's not really interest rate sensitive. A lot of their things are just locked in. They're going to borrow regardless of what interest rates are. And so the Fed's tools are less effective in a fiscally dominant environment. And if it gets extreme enough, it can actually be pro-cyclical in the sense that higher interest rates make federal interest expense larger and therefore increase the size of the deficits, which can be stimulating in some ways. And so it's a very different macro environment than has been the case for most of the past 40 years. We've been in fiscal dominance. Early stages was like 2018, 2019, but really more recently in a cyclical sense, the 2023, 2024, and still in 2025 period has been characterized by fiscal dominance.
Lyn Alden, the founder of Lyn Alden Investment Strategy
and the author of Broken Money, a best-selling book on the evolution of money.
She is a leading voice in macroeconomics markets and Bitcoin.
It's good. I continue to view that probably the biggest thing to focus on is U.S. fiscal deficits. I think that for years, I mean, during the whole pandemic and even after the pandemic, that has been an underappreciated topic in macro. It's increasingly understood, but I still feel like it's not fully conceptualized by a lot of market participants. Basically, the U.S. is now in fiscal dominance, which is to say a couple key things. One is that public sector deficits or public sector debt creation is now larger in most years than the sum total of private sector debt creation. So if you add up net new bank loans, net new corporate bond issuance, and even estimates of less liquid private credit deals, that whole arrangement is generally smaller in a given year than total federal deficit that year, total federal treasury issuance. And so the reason that's relevant is because the Fed's main tool for trying to either accelerate inflation and credit or decelerate inflation and credit is interest rates. And so when they raise interest rates, they can generally slow down the rate of borrowing by making borrowing less attractive. And if they want to accelerate borrowing, they can lower interest rates and therefore try to provide a boost. The problem is the federal government's not really interest rate sensitive. A lot of their things are just locked in. They're going to borrow regardless of what interest rates are. And so the Fed's tools are less effective in a fiscally dominant environment. And if it gets extreme enough, it can actually be pro-cyclical in the sense that higher interest rates make federal interest expense larger and therefore increase the size of the deficits, which can be stimulating in some ways. And so it's a very different macro environment than has been the case for most of the past 40 years. We've been in fiscal dominance. Early stages was like 2018, 2019, but really more recently in a cyclical sense, the 2023, 2024, and still in 2025 period has been characterized by fiscal dominance. Main drivers. Right now, there has been an uptick around the developed world, but the U.S. is a pretty significant outlier compared to, say, European countries or other Western nations. And there's a couple main reasons for that. One is, so for decades, higher public debt to GDP ratios from accumulating deficits have been offset by structurally declining interest rates. So for example, if you double your debt level, but you cut your interest rate in half, your interest expense stays the same. And that's largely kind of directionally what happened for about 4 decades. And the Western world hit zero, in some cases negative, in the late 2010s decade. Then during the kind of heart of the pandemic lockdowns and the deflationary shock, the brief one, and that was basically at the top in the bond market. And now bonds, let alone higher rates, if they just go sideways now, like for example, Switzerland already managed to get their interest rates back down, but they're not really going lower than they were before. Now we're kind of in this more sideways pattern most likely. So you no longer have an interest rate offset to larger accumulating stock of debt to GDP or debt in the absolute sense. And so that's one big factor that's gone now, so that adds to the deficit. The other one is that, and countries are on different time periods for this, but the U.S. Is really hitting its demographics cliff. And so Social Security had spent decades basically accumulating. So basically more was paid into it than was paid out. And in the late 2010s, we hit the peak there. It started rolling over. And according to the Social Security Administration themselves, for the next decade or so, going into around 2035, they're going to draw down their existing $3 trillion fund and push that back into the economy, as there's the whole very large baby boomer generation is retiring and will be increasingly retired, and drawing from that with fewer workers to really pay into that. And so that is pro deficits, pushing money back into the economy. And then there's other major factors. I mean, for decades, the U.S. and say NATO countries were reducing their military spending as a percentage of GDP. In the U.S.'s case, that was often basically that military spending was kind of going sideways, which when you have a rising nominal GDP would result in a decreasing military expenditure as a percentage of GDP. But because of a variety of current factors, we kind of hit the floor there, most likely. And now we're sideways to up in terms of military spending as a percentage of GDP. It's a little bit more notable in Europe because theirs got lower to begin with for many countries. But even in the U.S., when you consider multiple, extra bills and stuff for supporting some of what's going on, that adds to the deficit. So a bunch of different things together have kind of culminated in the 40-year period of what we've been in, the monetary dominance coming to an end. It's quite possible they could temporarily lose control, like we saw, for example, during the 2022 gilt crisis. The UK briefly lost control and required rather awkward central bank intervention, despite the fact that inflation was very high. So they had like the Bank of England literally had to cancel a speech on balance sheet reduction to instead do emergency balance sheet increases to put out the fire that was happening in leveraged gilt markets. The U.S. isn't in quite that vulnerable of a position, but we have occasional moments of vulnerability where sometimes the central bank has to step in. And we've already seen action by the Treasury to impact this. And so, for example, during Secretary Yellen's term, she issued a bunch of extra T-bills to fund the deficit at higher ratios than is normal. And that allowed them to, one, draw from the reverse repo facility, so basically pull liquidity that was already in there, get that back out into the banking system, so it doesn't strain the treasury market. And two, it's basically a cash equivalent. A T-bill is kind of like a cash equivalent. And so, various pools of capital can hold it with less risk because they don't have to worry about the price going down substantially because of interest rate increases and all the volatility that's associated with longer term bonds. And so one thing you generally see in emerging markets, if they have trouble with like the long end of their bond market, because if say you don't want to lend to a emerging market government for 20 years, 30 years, or maybe even 10 years, they'll issue more short-term paper. And directionally, that's what we've seen from the United States. Scott Bessent, the current Treasury Secretary, originally talked about fixing that. He said, we're going to lower long-term interest rates and we're going to term out the debt. So far, they've not done that. And they've specifically talked about the fact that because interest rates are higher than they expected them to be, they've blamed the Fed, but for whatever reason, the interest rates are higher than they expected them to be. They're not terming out their debt. They're continuing with the T-bill strategy. In addition, they've already talked about that, when Chairman Powell's term comes up in 2026, or at least his chairmanship term, not his full term, they plan to, put someone else in there that's more of a dove. That's more willing to put lower interest rates in place. So the combination of having a Fed that is somewhat supporting, whether they say it out loud or not, somewhat supporting, the large debt load, and tweaking their term structure. So there's not a lot of demand for long-term debt. They can issue more short-term debt, even though that's kind of a bad look. It's kind of an emerging market look, but they have that tool available to them. And then during emergencies, the Fed can step in and buy some. So while there certainly can be periods of volatility and pain in the bond market, I still think they have a ton of ammo for keeping the train on the tracks for any sort of investable time horizon. Yeah, right. So in April was kind of the peak tariff uncertainty period. That's when markets really had to freak out because some of these very high levels of tariffs were placed. And if you look at Trump's economic advisor, Stephen Myron, he wrote a paper in March 2024 that talked about how to kind of rebalance trade. And one of the assumptions that they had was that during the tariff negotiation process, it would strengthen the dollar, which would offset some of the tariffs and also give the U.S. more negotiating power. That hasn't played out. We've had a weaker dollar during the tariff negotiation period. And overall, I think the negotiations have been more fraught than they expected. They've had to kind of back off some of the more draconian things. A lot of those are still ongoing, so we don't know where this is going to land. So far, tariff revenue has increased, but even with the increased tariff revenue, deficits are still very large. And so it's not although I wouldn't call it completely immaterial. It is certainly a smaller factor than the overall structural trends that we just talked about. So you could potentially get, 100 or 200 or maybe even 300 billion in additional revenue in a given year. You're up against like a 2 trillion annualized deficit. So around the margins, you can affect it, but that's still, it's still a background thing to deal with. It's more about whether or not a given industry is hit hard. And unfortunately, one of the ways it's played out is that, the tariffs go on companies, and then some of the really big ones get exemptions. So it kind of like the middle and the smaller companies are the ones that end up getting stuck with it. That's how a lot of government programs often end up operating. So yeah, a lot of that's still ongoing. It certainly impacts industries, even if on a macro sense, it doesn't really too much affect the fiscal dominance thesis other than around the margins. There has been some delays in the current negotiation, but then there's also increased rhetoric around it. During the sell-off that occurred around April, that reduced the administration's negotiating position, but the subsequent rebound throughout late April, May, and June, and now into July. So the fact that the S&P 500 is at new highs, the fact that the bond market's less volatile than it was back then, that does give the administration more stronger position to try another round of tough negotiations. So I wouldn't be surprised that we entered another period of turmoil here to kind of see all these different entities and where they're going to, negotiate with each other. So I think it's less inflationary than many people think. I think the monetized fiscal deficits are a bigger inflationary factor than the tariffs, and that's because the tariffs don't increase the money supply. So ultimately, inflation is a money supply thing. There are other factors. But if you just have tariffs and you don't have anything that structurally increases the money supply, then generally speaking, a higher price somewhere takes prices from somewhere else. So if certain things go up in price because of tariffs, which are basically just taxes, then there are other things that are more discretionary that consumers or businesses could buy less of in order to keep prioritizing things that they kind of have to buy with the increased tariffs. And that could come out of other things that are measured in the consumer price basket. So for example, if say products out of China are more expensive and you still have to buy them just because we're pretty obviously reliant on their electronics and other things that they provide to us, especially in the for the next few years, you could buy something less from elsewhere. You could buy less luxury goods from France, for example, because consumers and businesses are pressured to, with the things that they're getting from China, just as a random example. In addition, tariffs can come out of corporate margins and therefore can basically come out of the stock market. And so when you have inflation, there's what people normally think of as consumer price inflation. But if you have a period of pretty significant money supply growth, but you also have high productivity, so for example, you keep energy, oil and gas flowing, no major constraints there. If you have no major restrictions in your labor force, if you have technological advancement like AI and stuff like that, then you can have pretty significant money supply growth while keeping CPI pretty contained, at least not growing as quickly as you'd expect. And what that generally means is that the spillover goes into asset prices. So the stock market, high quality real estate, gold, Bitcoin, those things will generally go up in that type of fast money supply growth, but substantial productivity period. However, if you do tariffs or other things that negatively impact corporate margins, that can potentially force the stock market to consolidate a little bit, and so you can get a little bit of an uptick in certain consumer prices, but you could get a weaker stock market, and then therefore that could negatively impact the wealth effect. You could have a little bit less around the margin spending from higher net worth individuals, which doesn't show up in kind of day-to-day spending, but that can show up in luxury goods. That can show up in certain types of more expensive travel. So there's the long story short of that whole kind of like rambling is that when you have something like tariffs rather than money supply growth that's fueling potential changes in prices, it's more likely to come out of somewhere else rather than just be additive in the broad sense. That's another issue with the whole fiscal dominance thing in general, is that people often think that if you do austerity, it can fix it. And austerity certainly helps prevent it from getting to where it is now. But once it's where it's at now, even attempts at austerity alone tend to fail. Because if you reduce the deficit one way or another, let's say you increase taxes, including tariffs or elsewhere, or you reduce spending somewhere substantially, generally speaking, that's going to impact like the stock market, and that's going to, with a lag, give you weaker capital gains taxes. And the U.S. is far more reliant on the stock market for overall tax revenue than most other Western nations. We are more financialized is probably the term to think of. And that's for two main reasons. One is our stock market relative to GDP is quite high because it's a global stock market. There's capital from all around the world invested in our stock market more so than other countries. We have some of the biggest, most diversified markets, companies in the world. And two, there's the big factor that a larger portion of U.S. executive compensation is from stock issuance, option issuance, that sort of thing, compared to, for example, Europe. So the combination of high wealth concentration and a lot of stock-based compensation means that when you get a flat or down year or two in the stock market, that does tend to impact high net worth paychecks pretty significantly, and therefore with lag impacts tax revenue as well. So it's a very complicated Gordian knot to try to untie, which is why I don't really expect it to be untied in a investable time horizon. Analysis suggests it will increase the deficit nominally. Secretary Bessent, the Treasury Secretary, he has argued and would argue that it'll increase GDP as well, and therefore won't necessarily lead to higher debt to GDP. That part's less important because stock prices are a nominal thing, and so is deficits, and so that's more of an argument whether it's good or bad. But in terms of its impact on investing, the nominal numbers tend to be pretty important, and so that's what we generally should expect is higher overall deficits. But my kind of key point is that nothing's really new here. This was kind of expected ever since the election. And so the big comparison is not what does this bill do versus the current deficits, which is, around the margins some, not a ton. It's more like compared to what many investors thought. Many investors thought that, especially because of the way they market it, is that they're going to reduce deficits. So not only are they keeping deficits where they were going to be, they're adding to them. So the delta between expectations and outcomes for a lot of market participants is pretty high. And so I think there's increasing realization among market participants that these deficits are not really a one administration thing. They're more structural. They're more embedded into the U.S. political system and more broadly other political systems. They're very entrenched for multiple reasons we discussed earlier. And so regardless of who's sitting in the Oval Office, these deficits are going to be high, and they'll have different flavors to them. Some groups will be better off or worse off depending on who's in that seat. But the Gordian knot here is complex enough that there's not just a simple fix to sharply reduce deficits. And so I think more and more market participants are realizing this is going to go on for many years. A fiscally dominant environment is a run it hot environment. So generally you get higher nominal GDP growth than you'd otherwise expect. Generally better nominally performing asset prices than you generally expect. Like as an extreme example, if you look at an emerging market recession, a lot of times their equities will go up in their local currency because their local currency is so weak. And it's a little bit different in a developed market, but when you have a developed market that's in stagflation, and it's you know, it's kind of this more fiscally dominant environment rather than a private sector credit contraction. You tend to get these like emerging market characteristics in a developed market, just less extreme. And so, generally speaking, prices surprise to the upside, you know, including asset prices. And you know, if you're worried about certain risks, like we talked before about how tariffs could negatively impact U.S. corporate margins, well, that's where assets like gold and Bitcoin or certain foreign equities can be helpful. And so I generally expect that it's, you know, the next 5 years is still generally an environment where you want to own more equities or more scarce assets than you do want to own bonds or cash, with maybe a minor caveat that non-U.S. equities are probably increasing in attractiveness here compared to U.S. equities, but it's very industry specific, very stock specific, and very asset specific. But all else being equal, I want to own assets that are more built for a run and hot environment, which is things that are not paper.